Welcome to Talk Tickers, your shortcut to understanding crucial earnings calls. Today, we're diving into East West Bank's first quarter of 2025.
That's right, EWB.
So the big question, I guess, is how well positioned are they for the rest of the year, especially with, all the economic uncertainty swirling around? Let's try and unpack this.
Okay. Well, starting off, East West Bank reported a pretty strong first quarter. They highlighted record revenue, actually.
Record revenue, okay.
Yeah, and solid loan growth, too. End-of-period loans hit a new high, $54 billion. That's up about 1% from last quarter.
Just 1%, but still a new high.
Exactly. And fee income also hit a record, climbing 8%. So good momentum there.
And what about the quality of those assets, the loans?
The asset quality remained strong. The annualized net charge-off ratio was quite low, 0.12%, or about $15 million.
Okay.
And the non-performing assets ratio, that actually decreased slightly, down to 0.24%.
Sounds good, but I saw they also proactively increased their allowance for loan losses to 1.35%.
They did. Yeah, that was mainly due to, increased economic uncertainty, as they put it, just being a bit more cautious.
Makes sense. So overall, strong returns then.
Very strong returns.
Yeah.
Nearly 16% return on tangible common equity and a 1.6% return on average assets. Tangible book value per share also grew nicely, up 3% quarter over quarter and 15% year over year.
Okay, so record revenue, loan growth holding up, strong asset quality, good returns. Sounds like a solid quarter on the surface, but let's dig in a bit. What's really driving this?
Sure. So let's start with that loan growth. Residential mortgages, demand was strong there. That helped yields even with higher rates. And commercial real estate lending also grew. They mentioned supporting long-term clients and some select multifamily projects.
So not just chasing any deal.
Right. And P&I balances saw some modest growth too, maybe reflecting some earlier activity. Importantly, they said lending trends into April remain positive.
Okay, so mortgages, CRE, what about deposits? That's always the other side of the coin, right? Especially now, are they getting the funding they need?
Yeah, key point. They talked about strategically optimizing deposit pricing. Seems they successfully held on to those Lunar New Year CD balances you hear about sometimes.
Right, those promotional ones.
Exactly. And they even captured some additional market share, apparently at lower pricing.
Oh, lower pricing. That's good.
Yeah. Average DDA demand deposit accounts, money market, and time deposit balances were all up quarter over quarter.
And the outlook?
They expect customer deposit growth to fund all their loan growth for the year.
Okay, that's significant. Funding loan growth internally with deposits is, it's a much stronger position than having to chase expensive wholesale funding.
Absolutely.
So how did all this translate into the bottom line? Net interest income, the margin.
Net interest income grew to $600 million. That was up $12 million from the previous quarter, even with fewer days in Q1.
Right.
And the net interest margin, or NIM, that expanded by 11 basis points, came in at 3.35%.
And what drove that NIM expansion? Was it loan yields or funding costs?
Primarily lower interest-bearing deposit costs. They were down 13 basis points. Also, some legacy hedges expired, which helped too.
Lower deposit costs. That's a big win in this environment.
It really is. They mentioned their interest-bearing deposit costs have actually dropped 62 basis points since the start of the cutting cycle, which beat their prior guidance. They expect NII to keep expanding.
Okay. And that record fee income, the 8% jump, was that just one thing or?
No, it was pretty broad-based. Yeah. Growth across 4 of their 5 major categories. So it suggests their diversification efforts are, paying off.
Diversification is always good to see. Now, expenses, growth is great, but are they keeping costs in check?
Seems so. They maintain an industry-leading efficiency ratio of 36.4%.
Wow, that is low.
Yeah. Total operating non-interest expense was $236 million. That included some seasonally higher payroll costs, which you expect in Q1, but their full-year expense guidance is unchanged.
Okay, running a tight ship then. Let's circle back to asset quality for a moment. You said charge-offs were low, non-performing assets down. But I did notice the criticized loan ratio ticked up.
You're right. Net charge-offs were way down, only 12 basis points compared to 48 last quarter. Non-performing assets also down. But yes, the criticized loan ratio rose to 2.3%.
What's in that criticized bucket?
Well, special mention loans were also up, although classified loans actually decreased slightly to 1.38%. The provision for credit losses was lower, though, $49 million versus $70 million last quarter.
So lower provision, but higher criticized loans. And that ties into the increased allowance you mentioned earlier. building reserves.
Exactly. The allowance grew to $735 million, or 1.35% of total loans. And like we said, they attributed that primarily to weighting those downside economic scenarios more heavily, given the uncertainty back in early April.
Prudent, I suppose.
Management seemed confident the reserves are adequate for the portfolio and their current economic outlook.
Okay. And capital. Sounds like they're well capitalized.
Very much so.
Yeah.
All regulatory capital ratios are well above the requirements. CET1, that's Common Equity Tier 1, is at 14.3%.
Strong.
And the tangible common equity ratio is 9.9%. They're also returning capital, repurchased about 920,000 shares for $85 million in the quarter.
Still got authorization left.
Yep, $244 million remaining, and they paid out $85 million in dividends too. Next one's payable May 16th.
Okay. They reiterated full year guidance, you said. Anything else on guidance? Taxes, maybe?
Yeah,
Okay.
bit more detail there.
They
They expect the amortization of tax credit and CRP investment expense to be in the range of $70 to $80 million for the year. But the full year effective tax rate is still expected to be below 23%.
Right. Now, the elephant in the room, perhaps, tariffs. Did they talk much about the potential impact?
They did address it head on. They noted, interestingly, that a lot of their clients actually started diversifying supply chains way back in 2017.
Oh, that early?
Yeah, and then accelerated those efforts during the pandemic. So it's not entirely new for them.
So what are they seeing now?
They've contacted over 500 commercial clients who might have exposure. And the feedback seems to be that most are adapting, shifting manufacturing, holding back shipments, passing on costs, various strategies.
Any major concerns?
They said clients with potentially significant adverse impact represent only about 1% of their total C&I loan portfolio. And importantly, they don't anticipate any credit losses from this currently.
Almost sounds like an opportunity for them, too.
They kind of hinted at that, yeah. This outreach might even help them gain some new clients who are looking for a bank that understands these issues.
Interesting angle. So back to capital return for a sec. Repurchases will continue, but what's the priority?
Priority one is maintaining a strong capital position. They want to support clients in, whatever environment comes along and keep their flexibility. Repurchases are opportunistic after that.
Makes sense. We touched on fee income being strong. Anything specific driving that? Wealth management, maybe?
Yes, wealth management fee income saw a really significant sequential jump. They put it down to higher customer activity, market volatility, driving demand for advice.
What kind of advice?
Across various products, apparently. Fixed income, insurance, structured notes, traditional investments, the whole gamut.
Okay. And looking ahead on expenses, you said guidance is unchanged, but any specific investments planned?
Yeah, they mentioned ongoing investments in cybersecurity, tech, enterprise risk, infrastructure. Those will continue through the year. Expect some impact on expenses probably in Q2 and Q3 from those.
Right, necessary costs of doing business these days. Let's talk NIM sensitivity. You said they expect NII expansion, but what are the risks? Rate cuts.
Well, balance sheet growth should help, obviously. But the benefit they've been getting from CDs repricing lower will diminish if rates just stay flat. Potential headwinds. Slower growth if the economy pools more. And yeah, rate cuts are a factor. Based on prior guidance, they estimated maybe a $2 million per month hit to NII for each 25 basis point cut.
Gotcha. And speaking of CDs, what's the maturity profile look like? Are a lot coming due soon?
Quite a bit, yeah. Around $10 billion in Q2 and another $8 billion in Q3.
And the rates on those maturing CDs?
This is key. The rates on the Q3 maturities have mostly already been repriced into the low 4% range. So if rates stay flat, there's not much more benefit to squeeze out there. Q2 maturities are apparently in a similar low 4% range too.
So that tailwind from repricing is fading a bit.
Exactly, in a flat rate world.
Okay. One more on asset quality, those criticized CRE loans you mentioned. Any particular concentration causing the increase? Office.
They said the increase in criticized commercial real estate, excluding multifamily, was pretty broad-based actually, across industrial, retail, other categories. No single significant concentration identified.
Okay. Diversified risk there too, perhaps. What about trade finance? With all the tariff talk, did they see a big jump in activity, people stocking up?
It sounds like any increase probably happened earlier, maybe Q4 last year, early Q1 this year. As customers anticipated potential tariffs and built inventory, they don't expect further big increases near term.
Right, that makes sense. The activity would precede the actual tariffs. And wealth management, you said organic growth is driving it. Are they looking at M&A there too?
They said organic growth is the main focus, but they're open to selective opportunities. That could include M&A to expand their capabilities or offerings in wealth management, keeping options open.
Okay. Hedging strategy, you mentioned some legacy ones rolling off, helped the NI. What's the plan going forward?
So $1 billion in swaps rolled off. That improved the blended receive fixed rate on what's left. They have about $500 million of forward starting swaps coming online in early Q3.
What rate on those?
Receive fixed rate of just under 4%, and then another $500 million later in the year.
Okay. And what are they doing in their securities portfolio? Buying anything interesting?
In Q1, they mainly bought agency mortgage-backed securities, specifically Ginnie Mae floaters. But they did start adding some fixed-rate securities, too, mostly HQLA Level 1 assets.
So focusing on quality and liquidity. Duration.
Overall portfolio duration was around 3 years at quarter end. They see value in fixed-rate securities yielding above, say, 5.5%, even though they've mostly been buying floaters recently.
And lastly, those FHLB advances, they still have some, right?
Yep, about $3.5 billion. They view those as a flexible funding piece. They'll keep looking at chances to pay them down with excess deposits, or maybe deploy funds into securities if the return looks better. It's about optimizing.
Okay, so bringing it all together then. Strong quarter, managing costs, seemingly navigating the deposit environment well, proactively managing risks like tariffs and credit. How well positioned are they, really?
I'd say relatively well positioned. The Q1 results were undeniably strong. Their proactive stance on potential risks, building the allowance, addressing tariffs with clients, and their focus on capital strength, it all suggests they're prepared to handle the uncertainty that's out there.
Right. It's a complex picture, but they seem to have a lot of the fundamentals in place.
Agreed.
Okay. Time for our favorite segment. This is not financial advice. Let's toss out an outrageous but plausible trade idea based on today's dive. You first.
All right. So building on that tariff discussion and supply chain diversification, how about this? Consider a long position in companies that actually help other businesses make that shift.
Interesting. Like who?
Could be businesses that specialize in, say, setting up manufacturing in places like Mexico or Southeast Asia. Or maybe supply chain management software companies that help manage these more complex, diversified chains. Even infrastructure plays in those regions.
So the companies enabling the diversification, not just the ones diversifying.
Exactly. The idea is if tariffs really do reshape global trade significantly, these enablers could see a big uptick in demand. It's definitely more of a longer-term idea, as these shifts take time.
A play on the changing plumbing of global trade. I like it. Outrageous, but plausible. Okay, my turn. How about going the other way? Explore a short position in some logistics and shipping companies that are heavily reliant specifically on the U.S.-China trade lane.
The direct counterbet.
Yeah. If tariffs do bite and trade volumes between just those two countries decrease significantly, those companies could face some serious headwinds, right? It's a direct bet against the smooth continuation of that specific massive trade flow.
Risky, but definitely plausible if you think tariffs will have a major cooling effect on that particular corridor. It contrasts nicely with the diversification facilitator idea.
Two sides of the tariff coin, perhaps? Remember, folks, these are just speculative ideas, definitely not financial advice. Please do your own homework.
Absolutely. Thorough research is key.
All right. That wraps up our deep dive into the East-West Bang earnings call. We've covered the strong Q1, the key metrics, management's take on the economy and tariffs, and some potential implications.
It's been a good look under the hood.
What are your thoughts on EWB's outlook? Think the tariff adaptation is real? Let us know. Thanks for joining us on Talk Tickers.
See you next time.